QuickBooks Online 2025 Refund Receipt Form. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are online in our browser searching for the QuickBooks Online Test Drive, the free sample company file available to everybody, searching for a result that has Intuit.com in the URL because Intuit's the owner of QuickBooks. We're going to be using the United States version of the software and verifying that we are not a robot. If you need to verify that you're not a robot. We're in the sample company file now, Craig's Design and Landscaping. I'm going to close the previous tab because it is no longer needed, and then open the reports like we do every time. The reports, they're on the left-hand side. We're in the favorites, right-clicking on the balance sheet. I'm going to open it in a new tab. Right-click in the profit and loss, otherwise known as the income statement, to open it in a new tab. Tapping to the right in the middle tab, closing the hamburger, changing the range to a 2-year time frame, 01/01/24 tab, 12/31/25 tab, selecting the drop down for years. So when I run it to refresh it, I see 2024 and 25 side by side. Let's tab to the right, do it one more time, put that top bun on the hamburger, close that hamburger, dang it, close the hamburger. 01/01/24 tab, 12/31/25. The patty's getting cold. The patty's getting cold. Put that top bun on there. We're going to go and see it on years, run it to refresh it, and we note that nothing is currently in 2025 except for that $34, including prior presentation transactions, because we refreshed the system and opened in incognito window, which I suggest you do if you're following along. Otherwise, you might have prior presentation transactions in your system, which might mess you up a little bit, but if you're aware of it, you might be okay with that as well. Let's go to the first tab, select the plus button. We've been looking at the cycles within cycles within cycles of the accounting system, focusing in on the forms related to the customer cycle, which you might call the sales cycle, the revenue cycle, the cycle in which we expect revenue at some point to be increasing the cash. We expect cash to be coming in at some point in the cycle for goods and services that we provide to customers. Last time we looked at the credit memo, which is more of an unusual kind of form, one of the most confusing and intimidating, scary types of forms because it doesn't happen all the time. It represents an unfortunate thing that happens. We have to reverse a sale and everything is backwards, right? It's a reversing transaction. Now we want to think about a situation where instead of reversing the accounts receivable, we had already received a payment from a customer and we're going to have to basically issue them the money back. In which case you might say, well, if I have to issue them the money back, that means money's going to come out of the checking account. That would be an expense form or a check form, right? Correct, you could do that. But the problem with that is that if I make an expense or check form, it won't tie into the subledger of the customer side of things because the expense or check forms are tied to the vendors, because typically we pay for things like buying the inventory from a vendor or paying for expenses or paying for property, plant, and equipment. We would like a check to go out in this case, but we want to tie it to the customer side of things so I can see it in the customer center, the subledger, and so on. So we're going to be using a refund receipt form, which will in essence do the same thing as the credit memo situation, but also kind of act like a check in that it will be decreasing the checking account for an expense type kind of transaction that we're actually paying back to the customer. All right, let's look at this in a flowchart format so we can see what's going on. This is the desktop home page. I know we're in QuickBooks Online. I know it's okay. It's just that we're looking at this to see the flow here because we have these nice arrows, and then we'll get back into the online format. So remember that when we're in the customer cycle, we could have a customer cycle that's really easy, like if you did gig work, if you work at YouTube or something and Google pays you, then you're just going to get the deposit and record that as income. It's unlikely that you're going to have to reverse that, and if you do, it might just be an automatic kind of transaction if the Google paid you incorrectly or something like that. But if we're at a cash register type of situation, then it's possible that we make a sale either for goods or services that are provided, and then for whatever reason, after they paid us, the customer is unhappy and they return possibly the merchandise or want their money back. Possibly they went to a movie theater and they got one of these new modern movies and they're like, oh my goodness, You took years off my life. That was terrible. I've seen better things on YouTube written by like a 5-year-old. It's ridiculous. I paid like 20 some dollars for this. And then you have to give them a refund. You're like, I know the movies are terrible these days. But any case, so then if you have to give the money back, then again, you would think that would happen with a check form, decreasing the actual checking account. But if we do that, again, we're not going to have it in the customer center because we're not dealing with a vendor. We're dealing with a customer. So that's the situation we have here. Now, you might say, hey, look, they might be like, we know the movie was terrible, but like at least maybe one movie in the next 5 years might be halfway decent according to the current environment that we're in. So what we'll do is we'll give you a credit into your account, in which case you might still use like a credit memo in that case, because you might say, hey, look, I'm going to give you a free movie later, basically, is what's happening. So now I have this outstanding credit that I can apply, which creates basically a negative receivable. And so that's something that could be an option. That negative receivable is a little bit of a questionable kind of transaction, however, because if we expect them to take us up on that offer, then it shouldn't really be a negative receivable. You would think it would be a positive liability situation. So we'll talk more about that kind of scenario, which is similar to a situation where we have prepayments. You get paid before the work is done. But that we might talk about that a little bit later. We also could have a situation where we invoice a client and then we have accounts receivable going up, and then maybe they return the merchandise before we actually collect from them. So in that case, we can issue the credit memo. That's where the credit memo makes most sense because it's going to be reversing the accounts receivable. However, if we had an invoice and then they paid us, they already paid us, and then they return, we're at the same point in time, in essence, as if we made the sale with the sales receipt. We can't really issue the credit memo because they already paid us. That would make a negative accounts receivable, unless we want to say that you have a negative credit balance that you can apply at some future time. Otherwise, we have to issue them a check. And once again, we don't want to issue a normal check because that's tied to vendors, and we want this information tied to the customer. All right, that's the scenario. So let's go back on over here and let's make a sales receipt. Let's do this. So we're going to say, let's say that we have just a sales receipt. So we'll say that we made a sale like at the cash register for customer one, generic customer one, once again. Adding that to the system, and I'll just keep the date, looks good, movie B to the N, payment method, whatever, I'll just make it cash. And so, and then I'm just going to put it directly into the checking account because the undeposited funds situation isn't what we're focused in on here. So I'll just say that goes directly into the checking account right now. So into the checking, and let's just make it we're going to make it an inventory item. So we have to deal with the issue of inventory, tracking inventory on a perpetual inventory system using a subledger to track not only the dollar amount, but the units. So I'm going to say inventory item 1. Let's copy that. Roger out, copy that. And then it's going to open up this thing. I'm going to say it's going to be an inventory item. And we will say that how many aren't on hand. Let's put 10 on hand. That will create a transaction for the purchase or increase of the inventory. And I'm going to say, put that on, at the beginning of the month. Let's say reorder point, let's just say is 0. Inventory account is the asset account that will go up when we purchase, down when we sell it. We're selling it here, so it's going to go down. It's going to go up by the 10 units, but then it's going to go down by the 1 unit that we sell here. The rate, we're going to sell them for, let's just say, good old $100. Income account that will be impacted when we make the sale, as we will here, is the sale of product income. And then the description, when we buy the inventory, we're going to say we buy them for, let's say, $70. And cost of goods sold will be the decrease. It'll decrease inventory when we sell it and record the expense account of cost of goods sold for the consumption of the inventory. So the net impact on net income when we sell it is going to be 100 minus 70. All right, let's save and close. And then we'll go, okay, so we had 10 on hand now because we just put the 10 on hand, which recorded a transaction. And we're going to say $100 tax is applied. So $8 tax. What's this going to do? Well, it's a sales receipt. So instead of accounts receivable going up, it's going to be increasing, in our case, the checking account instead of undeposited funds. And then the other side is going to go, and that's for the full amount, including the sales tax, which it's populating here, but for some reason it's not calculating until I record it. It's a little bit glitchy. Again, I think the sample company file is a little more glitchy than the QuickBooks file. So I'll record it and then I'll go back into it. And that sales tax should be calculating to $108 that we're going to be collecting. The other side then is going to be going to sales, which is $100. And then the difference of $8 is going to go into the sales tax payable, a liability account. And then we're going to have a decrease in inventory of the, what did we say, $70 driven by this item. And then cost of goods sold will increase $70. Net impact on net income, 100 minus cost of goods sold of 70 for $30 net impact. And the subledger will be impacted not only by dollar a unit, but by units of inventory. Okay, so let's save it and close it. I did that quick because I know we've seen it before. So I'm going to go back into the sales tab just to check out to make sure it populated properly the invoice after we recorded it. Let's go into the customers here and go into customer numero uno. That's number 1 for non-Spanish speakers. I've been learning Spanish with the YouTubes. The YouTubes got the subtitles. So there's 108. So if I go into that, we go into that. I used to try to learn with Star Wars, but then Star Wars went crazy. And so I have to watch other things that aren't lame these days. Anyway, so then I'm going to go then to the, I really like Disney Plus has a good language dubbing, but everything else is, okay, anyways, you're getting off track. Let's go to the tab to the right. We're going to run this thing. And then we're going to go into the checking account. The class is trying to distract me here again. Oh, it's trying to distract me, get me off topic. We're doing accountant here, accountant things. So we have the sales receipt. So there's the sales receipt. There's the 108 for the full amount, including the sales tax. Let's go back. Let's go to the tab to the right, run it again on the income statement. There's the $100. Let's go back to the tab to the left, the other side. The $8 is going into the Board of Equalization, which is basically sales tax payable. Sales tax payable, there's the $8. Let's go back up. And then then we also have inventory is going down. So here's the inventory. Let's go into that. Now we put the inventory on the books because we said we had 10 units of inventory. So we put the inventory on the books and then we sold one of them for $70, increasing the inventory or decreasing the inventory. And then on the income statement, we scroll down, there's the $70 in the cost of goods sold. Let's also take a look at the subledger for inventory. I'm going to right click on this tab up top to duplicate it. So I have another tab for the subledger of inventory, going then to the reports on the left-hand side. And we're going to say this is going to be the inventory valuation summary. There it is. So now let's just bring this up a few days just to make sure I have this covered. Close up the ham boogie. And so now we put 10 units on the books. We sold one of them. So we're down to 9 units of inventory. The dollar amount of inventory is currently at $1,226.25, which should tie out to what's on the balance sheet on inventory, $1,226.25. Now let's just mirror this over here on our Excel worksheet just to get an idea of this. Now we entered a sales receipt, but let's do it here. We're going to enter an invoice and then a receive payment, which will get us to the same point. We made a sale and they've already paid us for it. So if we entered an invoice, we'd have accounts receivable rather than it going directly into the checking account. So we'll go into accounts receivable. It went up by 108. Income going up with a credit. That's what the negative number represents here, a credit. And then we're going to say that sales tax payable, the liability, went up with a credit. So I know I'm using debits and credits. That's the easiest way to do it this way. So bear with me. We're going to then say that the cost of goods sold is going to be for the $70 for the sale of the inventory. And then inventory is going to go down with a credit of $70. So the net impact on net income, which is this bottom part of the trial balance, is $30. 100 minus 70. And then they will pay us. So let's say they actually pay us, which is going to be the second side of the transaction. So they paid us before they said, hey, I don't like this. And they're going to try to return it, right? So now we're going to say, all right, now they pay us. That means that cash is going to go up of 108 and accounts receivable is now down. So notice after accounts receivable is down, I can't really issue them a credit memo. Or if I do issue them a credit memo, it's going to result in a negative accounts receivable, which might be something I would like to do if I'm saying I'm not going to give you money back, but I will allow you to buy another ticket to the movie in our example, in the future. So we're in the same point as a sales receipt or an invoice after we've already received the payment. Let's say we want to give them a refund then. What we need to do then is exactly reverse basically what happened here. So if I look at it from an invoice, the accounts receivable has already been cashed. So I can look at this transaction and then basically reverse it. That's what the refund receipt will do. So now we're going to say cash is going to go down, and then we're going to say that the income is going to be go down. Now the income is the problem because maybe I don't want to put it into income, similar to what we saw with the credit memo. Maybe I want to put it into sales returns and allowances. And then the sales tax is going to be reversed, and then the cost of goods sold is going to be reversed. If they return the inventory and we think the inventory is still good, that means inventory is going to go back up, and we have to reverse the cost of goods sold. If the inventory is no good, then we're not going to do this second bit because we're not going to get any inventory. We're just going to refund them because they broke it or it was defective or something like that. So let's see what would happen. We're going to say, all right, cash is going to go down instead of accounts receivable going up, and then income is going to be reversed. Now this one, I closed out these transactions here, I think is what happened. So let's say like we're in the next year. This is going to be the negative sum of this is the idea. And then this top bit is just going to be the ending numbers here. To do it from here, let's redo this down to here. Boom, boom. All right, that makes sense. Okay. Except that this shouldn't be negative. This should just be the sum. Why is that negative? What are you doing? All right, now we're in balance. Okay. So now we're going to say, all right, so then we're going to reverse that, and then income down here is going to be a negative income because that's a debit. And then the sales tax is going to be reversed. And then we're going to have the cost of goods sold, which is going to be going the wrong way. So we have basically a net, decrease. And then we've got the inventory is going back on the books. Inventory goes back on the books for the $70. I think that's right. And then the one problem here is the net income, because normally I don't like net income going down. This is going the opposite way. It's debited and it's usually credited. Usually income only goes one way. That's why we might change this to sales returns and allowances. All right, so let's imagine that's over here. So let's go back to the first tab, and I can say, all right, if I go into my sales, I can go into my customers again. And then I go into my customer number 1, and customer number 1 is returning the merchandise or whatever, right? We're like, okay, fine, whatever, dude. And so we could then go into the plus button up top possibly and go into we could try to do the credit memo. Again, that would create a negative receivable, but no, we're going to give them the money back because refund the receipt. We just want to get this guy, this person is not worth it. They're just crazy. It's just best to pay them to go away because the merchandise was fine. I don't even know what their problem is. It's like, but whatever, we'll probably get sued. We're in California. We can't, we'll get sued or something. So we're just going to say whatever. Payment method, we'll say, we'll just say it's cash, and then refund from. Again, we can choose the checking account, or we can choose, undeposited funds. We're going to make it to the checking account, and it's going to be a check number. I'm not going to have a check number because I'm going to say it's electronic. And then we're going to say that the product is going to be, what was it? Inventory item number 1. So inventory item number 1, tax is applied. Once again, it's calculating the $8, but it's not adding it. So the total should be, you would think, the $108. Let's record it and then go back into it so this will populate properly. Let's go ahead and save and close. And then I'm going to say, okay, refund, customer name, amount, okay, boom. And then let's go back into it. Here's the sales receipt. Let's edit it so we can see it, and it's properly calculating down here at the 108. So what does this form do? Well, it's a sales receipt form, which is a credit memo. It's a cross between a credit memo and like an expense or check form, meaning it's a form that's going to decrease, the checking account, like a check form, similar to like a bill payment form, which is a specialized kind of check form, or a payroll tax check form, or payroll check form. So it's a check form that has a specific thing that it is doing rather than just paying for an expense, right? And then the rest of it is going to be basically like a credit memo, in that it's going to be reversing the cash. So cash is going down now for the 108 because they already paid us. The other side is going to be going to revenue, which is the questionable item for the 100, because we're decreasing the revenue account, which we don't typically like to do, but we'll talk about that more later. And then the difference of $8 is decreasing the sales tax payable. And then we're putting the inventory back on the books at $70, driven by the item, which knows, because we're using a perpetual inventory system, and we're decreasing cost of goods sold. So the net impact on net income is 100 minus the cost of goods sold impact of 70. All right, so let's save it and close it. So there we have that. And now you can see then these two have been recorded. So here's the sales receipt. We had already been paid on the sales receipt. So when I go into it, we already have the payment. And then of course we have up here the refund that is nice and tracked within the customer center. So let's go back to the balance sheet now and just check it out. So I can go into the checking, I run it. Let's go into the checking, checking out the checking. It went up by 108 for the sale that we made, and then we made a refund of the 108 for the full amount. Let's go back. The other side's on the income statement, running it to refresh it. And now we see that the sale of product goes back down. If I go into it, I can see that it went up with the sales receipt, down with the refund. Let's go back. We can also see the difference between the 100 and 108, the $8 on the balance sheet, which is the sales tax payable in the Board of Equalization payable, because that's who we pay in California here. Horrible play. I don't even know what they do with the money. I don't even want to know. You don't even want to know. It's crazy how much taxes we pay here, and they don't do nothing. We just had a bunch of fires. I think they could have. Anyway, we don't even have any water. They got fires, no water. How much taxes are we? It's ridiculous, man. What's going on around here? Anyway, the inventory. So I go into the inventory. We've got then the sales receipt, and it goes back up again for the $70. Let's go back, and then in the profit and loss, we can see that the cost of goods sold. Let's go into that. And so we had the expense, and then we reversed it. So there is that. Looks good. We can also see in the subledger, if I run the subledger, inventory's back on the books for the $10 units now. So inventory is now at the $1,296.25, which should tie out to what's on the balance sheet. Balance sheet of inventory, $1,296.25. All right, let's do it again. This time I want to fix this bit. Meaning I don't want to reverse the sales to the sales account, but use, once again, sales returns and allowances, a contra income account. So this time let's do an invoice and then the receive payment to do the full process. I'm going to do an invoice, and this will be for customer numero dos, customer 2. Okay, save it. Why can't you come up with a unique name? That's lame. Can't you make it interesting? Customer 2? Customer 2, okay. Whatever, unique name. inventory item 1. This is going to be, all right, so there it is. So there's, what's this going to do? It's an invoice. It's going to increase accounts receivable by 108. The other side's going to go to sales for $100. Difference $8 in sales tax payable. And the inventory is going to go down by the $70, driven by the item. Cost of goods sold is going to go up by the $70. Net impact on net income, 100 minus cost of goods 70 is 30. And the subledger for customer number 2, accounts receivable, is going to go up, and the subledger for inventory is going to go down, tracking it not only by dollar amount, but also by unit. Let's save it and close it and just double check it. Balance sheet, run it to refresh it. This time we put that into the A to the R, accounts receivable. And so there it is on the 108. Let's go back. The other side's on the P&L, profit and loss. 100 and only 100 over here because we don't include the sales tax. Back to the balance sheet. Sales tax portions in the board of equalization. $8. Those people that just take the money and don't even buy water for the fires that we know are going to happen. They hire people based on craziness. Can you carry a hose? That's how you should be hiring people. Do you have the strength to hold a hose that's shooting water out of it? That's what I'd like to. Anyways, here's the cost, $70. And then we're going to go back to the first tab and we're going to say that inventory is going down by the $70. Let's go back, and in the subledger, running the subledger, we can see that the units of inventory are down to 9. So now we're at the 122625. Let's go back to the balance sheet. Inventory 122625. Let's go to the first tab, and we're going to go into the sales on the left-hand side. Once again, into the customers. We'll go down into customer numero dos, customer 2. So we have the customer here now. If they return the merchandise before we receive the money, we might issue a credit memo. But let's say no. Let's say that they're going to pay us the money now. So we're going to say we get a receive payment from customer numero dos. And we're going to say that this happened on let's just say it's a cash payment. We're going to put it directly into the checking account. Once again, $108. This is a received payment. What's it going to do? It's going to decrease the accounts receivable. The other side's going into the checking for that invoice, connecting it to the invoice. Let's go ahead and save it and close it. And there it is. So we look at the detail here. So we can see now the payment is closed and we can see the invoice is closed. They've already paid us. If we go to the balance sheet, we can run it to refresh it. We can go into that checking account. We can see the checking account went up by the payment, 108. We can go back and we can see that the other side is the A to the R, the accounts to the receivable, the Pirates account, the R account. All right, the payment is there. Back to the first tab. Now they come in and they say, we want to return the merchandise. And it's like, dude, what do you mean, man? It works fine. And they're like, we'll sue you. We live in California. We can sue you for anything, and you gotta pay us. And they're like, okay, we'll just pay you then. Whatever. I'm moving. It's ridiculous. Okay. So now we're gonna say, okay, whatever. We need to pay these people because they broke our merchandise and now they want their money. So we're gonna, okay, whatever, dude. I don't even know how you broke it. You must have hit it with a sledgehammer. Thing's been crafted with skill that's beyond anyway. We're going to do a refund receipt. Now, we could issue a credit memo now, but that would create a negative receivable. We're like, dude, we're better just pay this person off. They're crazy. So we're going to say, we're just going to give them a refund the receipt. Hopefully they go away. And so this is going to be customer number 2. And so we're going to say this happened on the 3rd. And let's say same kind of thing here. So this was inventory item number 1. But now what we want to do is we want to make it so it doesn't go to decrease revenue, but instead the allowance for doubtful accounts. So I'm going to make another item just called allowance for doubtful accounts. This is the tricky, this is where the magic happens. This is the tricky move, the sleight of hand that we're going to be putting into play here. This is where it happens. I'm going to make it a service item, and then I'm going to say that it's going to be just called allowance for doubtful accounts, let's say. And I'm not going to put a dollar amount because I'll just populate it myself. But if it's going to the inventory, maybe I want it to go to a new account, which is going to be returns and allowances. So I'm going to add the account on the fly as we go. I'm sitting on a fly as the wings are flapping, and I'm adding the account because I'm adding it on the fly. So we're going to say this is going to be what kind of account? It's going to be an income type of account, even though it's going to act like an expense. In other words, and I'm just gonna say service fee, whatever. I'm not too worried about that detail type. So allowance for doubtful accounts, I think that's good. Let's go ahead and save it and close it. I think that's what we want. Do I want taxes? Let's just take the taxes off and I can apply them when necessary. So I'm gonna say no taxes, and then I'll just be able to check it off when I need it. And so we'll save it. And so there it is. So what I'm gonna do is I'm gonna put the $100 down here instead of up here, but I will apply the tax out because we do need it, so that $8 will be calculating. So you might say, well, why would you do that? What's the difference? Well, this will record the same thing, but it'll record the revenue side to allowance for doubtful accounts instead of decreasing the revenue, and it will still record the return of the inventory. Now, again, if this person hit it with a sledgehammer and they still return it, they're like, oh, it broke somehow, dude. I don't know what happened. We're like, okay, whatever. Then maybe we don't want this top bit at all. We might trash it because our inventory is not going back up, in which case we might just use this second line item. But if we have to increase the inventory, then we're going to be up here. So our policy is we increase the inventory and then we determine if it's no good, and then we'll write it off afterwards, we're going to imagine. So let's save it and close it. And select the account for this transactions. I didn't select the account. Refund form, let's say it's checking, and I'm going to delete the number, imagining it's an electronic transfer. All right, let's try it again. Otra vez, try it again if you could. Refund receipt saved. Okay, I thought I said save and close. You saved it, but you didn't close it. Follow the directions, QuickBooks. QuickBooks is getting slow. I'm going to call you slow books if you don't get your crap together, man. What did you need to move your central office out of California. I could see you're slowing down already. You need to do like SpaceX. You got to get out of here. This place is putting down the regulations. Anyway, so we're going to say what happened then. We're going to say if I go into let's run this thing and go into the checking account. And then now we can see that the refund happened, 108. The other side is going to go to the profit and loss, running it, the P and the L. This time, this is where the key is. This time, we didn't put it into income, but the refund went into donde. Oh, here it is up top because it starts with an A. So it's in income up top. Now, if I had account numbers, I can more easily, put it somewhere else, or I might make it a sub account of sales returns and allowances. But the point is that revenue only goes one direction and is up, and then this one is going to act like an expense, but it's in the revenue section to make like a net revenue account. All right, we've seen all the rest of it, so that's basically, I won't go through each of the other ones. Let's go to the first tab here, but now we can see this nice trail of what happened for this particular customer, and so and that's going to be the point. Now, I just want to point out one more time that there is a scenario where you might say, hey, look, instead of having an invoice, maybe I give them a credit memo to result in a negative amount here, so that we can say we'll allow you to maybe buy something later and apply the credit to a future purchase. So we might talk more about that later. But when you have that happening, you have this question of, well, if I have a negative receivable and I expect them to actually follow through with it, then maybe it should be a liability instead of a negative receivable. But if I had a liability, like with unearned revenue, the problem is I don't have a subledger that ties out to the liability account for customers because the customer subledger is accounts receivable. So typically from an internal bookkeeping side, it works great to have like a negative receivable because then I can see it right here. And if they make a sale in the future, I could go ahead and apply out that credit to a future invoice, and that would be fine. That would be fine to do. So just something to keep in mind.